This RWA asset is going to the moon, and you probably don't even realize it. What's going on, everybody? It's your boy JT, and we are back to the Crypto Den. We have an exciting topic, as always, here on the channel, where we only talk about crypto, blockchain, and the actual fundamentals of what this stuff is. And today we're talking about stablecoins, because there's a bunch of news going on right now. And I got followers that are actually commenting and asking a very smart questions, like, what is a Depeg? What does that mean? How does that even look? It's just supposed to be stable, so when it goes below $1, I'm like scared. I do believe this is like blockchain's iPhone moment. A lot of you don't know that it is actually a real world asset. Everyone's always talking about RWA, real world asset tokenization, and we're going to get into all this. I got all these awesome screens over here to show you the actual research that you can do to become more educated on this stuff, right? That's what we do here. So if you like that stuff, hit the subscribe button, because I am a professional hedge fund manager. I run a digital asset hedge fund called Bleeding Edge Capital out of Cincinnati, Ohio. I have more than a decade of software development experience, and I use all of that to dive into this stuff, bring it high level so you guys can get more educated. Let's get into stable coins. The very first thing that is worth going into is understanding the different types of stable coins, okay? Because there are a lot. You have types of stable coins. A lot of people get this confused because you think there's just like it's equal to $1, it's equal to $1, it's equal to $1, but there's a few different ways they get it to equal to $1. The ones that you're most likely familiar with, like USDC and USDT, those are the fiat-backed stablecoins. What that essentially means is you give the protocol $1, the protocol takes that dollar, buys a treasury bill, 10-year, gets yield, keeps all that yield to itself. Not all of them do this, but Tether, USDC, they get that treasury yield for free, and then they give you a token, which costs them nothing to mint, that you use to represent that dollar. They're hypothecating your dollar almost like a bank. And then you use the stable coin, let's say you go made money, you went and you got $100, you did some crazy stuff with some tokens, got it all back to 1,000 stable tokens instead of 100. You go back, you can then get $1,000 worth of stable tokens. You just get that dollar back, all 1,000 of them, and you're good to go. Okay, because it's 1-to-1. For every single dollar of a stable token that is circulating on those two protocols, there's exactly that many dollars being held at a bank as collateral or being invested into treasury bills with a balance. They have a whole treasury management system. But that's the general idea. The other way to do it is like DAI, okay, where it's the exact same principle, but instead of treasury bills, they buy crypto with the dollars you put in. And they offer higher yield because the crypto generates more yield. So maybe they buy Bitcoin, Ethereum. You can go look at what they actually buy. A commodity-backed stablecoin down here, same concept as a crypto collateralized stablecoin, but instead they buy gold instead of crypto or instead of T-bills. So the basic idea is dollars in, asset gets bought in the back end to get yield while you use the stable token so they can have more. That way they're not ever worried about too many redemptions, especially if you have something like gold or Bitcoin that the price is, not fixed. It's going to go up and down. So that's the general idea. And then these things, these are trash. These are complete garbage. Okay. This is actually what brought down the market last bull cycle. This is Do Kwon. Do Kwon was the gentleman running it. It was basically a 20% yield savings account, or BlockFi had 9%. But realistically, what they're doing is they are managing the supply and demand, and they're doing whatever they want with the deposits, and eventually they blow up. You can think of it that way. You want to avoid algorithmic stablecoins, and I would say the safest would be the treasury backed, and then the gold backed, and then finally crypto backed, for obvious reasons. But these are the general concepts of what the stablecoins are, and they all work the same. They basically hypothecate their bank. Now, the Genius Act is something that happened in July of 25 that completely changed the stablecoin market. So now there's actual American regulations for stablecoins. This is what they are. This is how you do them. Only certain people can be issuers. There's going to be a licensing protocol for this, but we're going to give you the regulatory guardrails to make everyone feel comfortable doing this, which is exactly what they did. The big thing to take away is they know know who's going to regulate them. They know how to issue stablecoins legally and not get in trouble. They know all of the common practices, and they also have 5 years of Tether and USDC just pounding the market and proving what works and doesn't work. And they're even starting to sell their token as a back-end offering. Is like, hey, stablecoin is a service, right? We'll just white label, split the fees. It's genius. And that's really why I think Circle gets the valuation it does in public markets, because they can license out essentially their token and start getting more TVL. Like, their distribution through Coinbase won't nearly be as important to them in, the mid to long term. But that's the general gist of what the Genius Act did. Now, the impact it has is real. Take a look at this. This is the total stablecoin market cap. This is without any regulatory certainty. We're growing at like 10 million, 100 million, a few billion, very slow. From like 2018, 30 million to 2020. So in 2 years, we go to 5 billion. That is significant growth, guys. Like, if I zoomed, see that? But, when in doubt, zoom out. It's pretty flat compared to what happens, but you can see that. Then we go from the next 2 years, 5 billion to 150 billion. This is with the worst regulatory framework you could imagine. Like, people are going to jail, Do Kwon happens right here, falls off a cliff real quick. People are terrified. He lost 30 something billion off the algorithmic stablecoin. We take a long time to get past that level, right before the Genius Act. Then the Genius Act, we go from 200, actually, it's so recent. Let's see, 250 up to 305. So we've added 50 billion since the bill, and leading up to the bill, another 50 billion. Basically, what I'm trying to show you guys is this stuff is growing like a weed. And in the hook, I mentioned we're talking about real world asset tokenization on here. We genuinely are. I want to show you something. This website tracks RWA efforts. Okay, so this is everything that is a real world asset tokenized by sector: private credit, treasuries, commodities, alt funds, right? Non-US government debt, so private debt, private credit, stocks. You get the idea. There's tons of this stuff. Hundreds of millions up to 15 billion in private credit. But look at this. Show 296 billion of stablecoins. Look at that. Stablecoins are real world assets, y'all, because it's a dollar. It's a US dollar being tokenized. That's really important to understand, that RWA has been here since 2018, and we've just been in an uptrend only since then. And look at the Genius Act passing and how much this stuff is growing now. And this is just the beginning for all this other stuff. If you go look at this chart in 2018, they're right here. They're growing like a clip. Like, if I zoom in, look at that. They're like right here. That's right where this stuff is. I think 5 years from now, when you zoom out like this, it's going to look like that. And stablecoins are the beginning of it, because when you have dollars and you want to go get 5-8%, you're not getting any yield from the dollars that are sitting there. The issuer is. You want to go get yield, and then you can go get gold. You can basically do everything you do in your retirement account and your stocks and all that stuff, but you can do it all in your DeFi wallet. Everything's going to really change, and that's the reality where we're going. It's up only. And then finally, to understand how significant the Genius Act is and the Trump administration for stablecoins in general, this is the Treasury Secretary. This is his actual Twitter account. And he believes that the Genius Act will push stablecoins to 3.7 trillion by 2030. That is over a 10x. And that's not just me saying that. That is Treasury Secretary. If that's what he thinks, he has all the inside information. He knows every company filing for charters. He just sees this. And the reason why it's actually super important for him and America and his job and just us in general is, if you put $1 in, you get a treasury bill. And our treasuries are disgusting. Our dollar is weak. People do not want our debt. They want our equity because the dollar is cheap. So people want to invest in America when the dollar is cheap, right? Because their currency will go further. That's basically Trump and Scott's plan. But stablecoins will build demand for T-bills, because if you put $1 in, that issuer has to go buy a T-bill. So his job is to sell their debt in part. That is his job. And stablecoins are a great rail for selling American debt. And you can just see the sentiment here. It's a win-win-win. Finally, before we get into the risks of stables, right? I want you guys to understand everything about them. So we talked about what they are, the differences between them, their future outlook, the inner workings, the piping of them. We're going to get into the market now. This is the marketplace. And after that, we're going to get into all the risks with stablecoins. stablecoins. And then you will be an expert at stablecoins afterwards. Okay. So here you can see the total value locked for all of the issuers. Now, I personally have money in these two right here, and so does my fund. Unless you're doing public stocks with Circle, which I'm not, or private, you're a very wealthy individual and you have access to private rounds at I think they're $50 million minimum with Tether. These two are young but growing. I personally am very excited about both of these. This is the TVL of every network in their stablecoin. You can see Ethereum here, Tron here, Solana, Avalanche. You can start doing some obvious math here. Tron and Ethereum are the winners. Ethereum with USDC, Tron with USDT. This would be like the East and the West. Tron is Asia, and Ethereum is probably more Western. That's Tether's product. Tether on Ethereum, Tether on Tron. That's actually crazy. Wow, I might have gotten that wrong. Where's USDC on this thing? Oh, I'm looking at Tether. That's why. Okay. That makes sense. That is pretty crazy though, right? If you just look at all that. Now, if I go to USDC, we can take a little comparison here. 74 billion, so about half of what Tether is. Let's see if we can get... That's the market. You go into Sky real quick. Yeah, they just updated their token protocol, so I can't show you their revenue. They got about 5%. Now, Athena's coming up hot last 3 years. They've been around that long. Yeah, they just came out in 2024. If you take a look at this, 500 million in about a year. It's not terrible. That's the market though, guys. That's the market. Now, how in the world do these things depeg? And I was sitting down thinking of all the ways, trying to figure out a way to summarize it for you guys. And I just thought, you know what? I'm going to take this to my boy Claude because I love AI. And I want to dive into one that just happened recently, which is why we're talking about this on the video. But the first thing to know is this stuff can be risky because back in, okay, let's go back to the previous market, Silicon Valley Bank. Silicon Valley Bank, SVB, they went bankrupt, and Circle, USDC, depeg almost 10% because 10% of the dollars you gave Circle were being held at SVB. That underlying bank went bankrupt. Circle had to go get a bridge loan, repair the liquidity or the collateral. That's what we're talking about here, collateral problems. They had to go fix it, then wait for bankruptcy to get their money back from that bank, right? So that is important. Where the dollars actually go. It's no different than a mutual fund or an insurance product. Where are they actually investing in, right? Where are they getting their yield? That is the most important question. If you don't remember anything else, if you're considering putting a significant amount of money into a stablecoin, you have to ask, where are they getting their yield? And if it doesn't make sense, if it's too good to be true, it definitely is. Circle just did one-to-one fiat collateralized buying treasury bills, the most conservative approach you can. Same with Tether. It depegged because of the bank. So that is what collateral problems would be. Luna is an algorithmic failure. It's one of those algorithmic stablecoins we talked about in the beginning. Basically, no direct collateral. They use algorithms and smart contracts to automatically manage the stablecoin supply and demand to maintain its price peg. So dollar in, dollar out, issue this, burn this. It's basically always minting and burning tokens to keep the same amount. And it's an algorithm doing it. So when you have big movements, big sell-offs, that's when you can really start testing the algorithm and start messing with it. And that's essentially what happened with Do Kwon, okay? The Terra protocol. It was a system that had too many redemptions. This guy basically lied to all of the investors saying it was safe, it was going to do this, it was going to do that, and he pleaded guilty to fraud to avoid life in prison. That is a serious risk. Where are they getting their yield? He offered 20% from an algorithm. 20%. You're playing, again, stupid games. You get stupid prizes. Liquidity issues, that is essentially what we're talking about. If Circle puts, I think they do a good job. I haven't really looked into it, but let's say 10% into 10 different banks, and let's say 6 fail. Circle will fail and you will lose your money. This is when you have bank runs, major exchanges could delist it, right? Which means your supply is going to get throttled. It's going to get choked. That could happen as well. The collateral problem is where the stable token is hypothecated, and then the liquidity problem is the actual tokens out there and how you access them could change. Regulations could change until the Genius Act. But all of that would affect the ability for users to actually put money in and redeem their money back and all that stuff, which can dramatically affect it. Loss of confidence, the FUD, all this stuff you guys can understand, Do Kwon, all the depegging, people could actually cause liquidity problems from sentiment problems, if that makes sense. We don't have to dive into sentiment that much, but if all of the world is afraid of World War III and everyone runs to their banks, and then you have a collateralized issue, if everyone wants to get out of crypto immediately for some some reason, like quantum scares, you'll have a liquidity issue, things like that. That's what all this stuff would be. And then the technical problems are the last kind of sector that I'll get into. And there's tons of them: smart contracts, the logic, how everything gets executed, all of that. And an algorithmic one could matter, how they actually have their limits for redemptions per block and all this stuff. Like, yes, that matters, but it's super technical. I don't really want to get into it because I feel like this is high level stablecoins for dummies, right? But the price oracles is what actually just happened. Just because you only know this stable token is worth $1 because you're told it's worth $1. On the interface, it shows you $1. The only way that your interface, your wallet or your exchange, like it knows that the value is $1 is because of price oracles. That's why I invest in oracle providers such as Pith and Link. I really like those two. Their main job is to bring price data to your screen. And if an oracle that is responsible for that stable token messes up, has an issue, whatever, the price, nothing actually happened. Everything we just covered, liquidity problems, collateral problems, all that stuff, fine. Algorithmic problems, everything's fine, but the price oracle just for whatever reason breaks, and then the price doesn't update, and then the supply keeps going, right? And the next thing you know, it looks like it's worth more or less than $1, all because of that little piece disrupting the flow of data to your screen. And that's actually what just recently happened, which made me think to make this video and why the community is asking about this stuff. So the price oracles can make it look like it's actually depegged when it hasn't. This stuff it's the future. It is the start of RWA. It is the simplest real world asset to tokenize. And I think in terms of RWA, as we go forward in the next year, 2 years, 3 years, 5 years, you're going to see every single asset that is the closest to $1 get tokenized. Like the dollar is the simplest asset to tokenize. We're going to start tokenizing assets in levels of complexity sequentially. So I would expect, and you saw it on that rwa.xyz account, I think you're going to see credit, T-bills, all the different variations of dollars, and then probably into hard commodities like gold, then eventually real estate. Everyone talks about real estate, but it is incredibly difficult to tokenize because it is a complex asset. But what is for sure to stay is stablecoins. Subscribe, comment, like, share. Until next time, take care of one another. Peace and love.